All right, what I'm going to attempt to do is to try to explain this again, this comprehensive problem involving consolidation of Richmond Company into Miller Company at the date of acquisition. So this would be as of assuming that the purchase took place on December 31st and that the consolidated financial statements would take place at the same time. A couple of preliminaries here. First, that Miller is going to issue 50,000 shares of its own stock that has a par value of par value of $20, but a fair market value of 32. So that's going to be the method of payment. Likewise, a couple of little caveats here that we talked about. One, that there is this contingency. The executives of Miller would like the executives of Richmond to stay on, that they're very happy with the success of that company. So they've offered to pay them a bonus, if you will, over 3 years if they achieve certain profits targets. And if you take the present value of those promises, that would equal $100,000. So that is actually added to the cost of Richmond Company. Now, the other thing is that there are the stock issuance cost and the legal fees. Now, the legal fees are always treated as an expense, as a period cost in the year in which they're paid. They're simply expensed. Stock issuance costs are a little quirky. They're treated as a reduction in the paid in excess account of Miller Company at the time of acquisition. So this is one of these two things here, that is the contingency and the additional fees that are paid. You're simply going to have to remember that or put them in your notes to how to handle that. They don't always fit, they don't always seem quite logical, but that's going to take place. Likewise, an assumption is that Richmond is going to value itself at its fair market value. That both parties, the executives of Miller and the executives of Richmond, are very clear that if you take a look at the fair market value of the net assets of Richmond, it's the $1,510,000. So not only is Richmond going to demand that, Miller is going to be willing to pay it. You're dealing with two rational parties that clearly understand that some of the assets are seriously undervalued, and there are some unreported assets that Miller is willing to give value to and pay for, and those are going to be recognized at the time of acquisition. Okay, so the first requirement is to assume that at the time of the purchase, Richmond ceases to exist, that you have essentially that simply it ceases to exist, a statutory merger, and assets of Richmond are simply moved or added to the assets of Miller. And it's in some ways a little bit easier than it is to try to do a consolidation. Now, just to kind of review a couple of things, the total value that Miller is willing to give is the $1.7 million, and that is the 50,000 shares at $32, which equals 1.6, plus the $100,000 of contingency. Now, just taking this, cash is cash, so that comes over. The receivables, there's no adjusting at all that takes place here. These assets here are brought in at their fair market value. Now, again, if I go back up here, that you see cash is $200,000, receivables $290, inventory $820, so forth. Those are simply debited. That with a statutory merger, Richmond ceases to exist, Miller picks up the assets, and they're simply added to the amount that they're paying here. Now, a couple of things that are a little different here that normally you would never see except in a situation of consolidation or a statutory merger, that is at the time of purchase of another corporation. Normally, something like unpatented technology, under normal FASB or US GAAP and research and development, these things are never recognized as an asset because of the uncertainty of their value. But in this particular case, you have very clear objective evidence that Miller has valued them and is willing to pay for them. So they're brought in and will be either go into some sort of asset of perhaps be redesignated, renamed, or will be written off. Now, if you look at the amount of fair market value of 1.5 million that Miller paid the 1.7, so there's this resulting goodwill of $190,000. Accounts payable are brought in, along with notes payable from Richmond. The additional common stock that Miller issued, plus the paid in excess for the 50,000 shares. Now we come to these last couple of little quirky transactions. As I said, the legal fees are considered a professional expense. They are simply expense in the time period in which they occur. The stock issuance cost, on the other hand, are kind of the quirky part of it. They're not expensed, but rather they are treated as an offset against the paid in excess. That is, the paid in excess for common stock, and you're going to debit that for $10,000 credit cash or some sort of stock issuance cost. All right. Now, scenario number 2 is probably the more typical situation, and that is both companies are going to continue to have separate legal existence. And so you're going to be required to consolidate. Now, keep in mind, there are two things you have to keep in mind. That Miller, for internal reporting purposes, will probably continue to use the equity method to account for its investment in Richmond. Even though they own 100%, equity doesn't stop at 100%. So for internal purposes to value that investment, that specific asset, they're going to continue to use the equity method. Now, the book talks about several other methods that can be used, but we're going to focus in simply assuming always that the parent corporation, such as Miller in this case, will use the equity method. And again, the assumption is both continue to operate independent of each other. Now, GAAP also requires that when it comes time to report to outsiders, then the rules of consolidation kick in. Equity is required regardless of internal or external if you own more than 20%. But once you own more than 50%, then the rules for external reporting kick in, and you must use the consolidated method. Consolidation is simply an application of the accounting maxim of substance over form. You have sort of a legal fiction, but an economic reality. In this case, in this chapter, we're going to assume 100% ownership at the date of acquisition. So we're not going to worry about anything regarding income. So Miller is acquiring 100% of the stock of Richmond on December 31st. So they account for that in their investment account, and then they immediately turn around and they will issue consolidated financial statements. So internally, these are the internal debit and credit entries that are made. These are on the books of Miller. These are the formal journal entries. So they will debit the full amount. They will credit the contingent, okay, as a type of liability that they have. Likewise, they will credit common stock at par value for $1 million and the paid in excess. These two entries down here would be the same regardless. Whether I have a statutory merger, whether I have a consolidation, I'm going to recognize the expenses for legal fees, and the company will recognize the stock issuance cost as a reduction in paid in excess. All right, now comes the part that's a little bit tricky for people, and that is this element of, at the time of acquisition, this is right up here, what we have up here are the journal entries that Miller would make. Now, those have been made. That's an assumption. So this is number 1, okay? And this would be number 2. That is, after the investment has been booked, the journal entries have been made in Miller. Miller now needs to turn around and issue consolidated financial statements. In this case, we're going to focus simply on the balance sheet. Since it's at the end of the year, there is no income. The income of Richmond is in its retained earnings, which Miller has purchased. Miller has its own net income, which is going to be seen here in a minute in its income statement, which will flow down into its retained earnings as well. All right. So the fair value that they paid, okay, was the 1.7. The book value is the 600,000. So there was excess. And as we discussed earlier, both parties understood that a number of the assets needed to be changed, that they don't reflect their true market value. It's not unusual to see, for example, that receivables would be written down. When both parties take a look at it, they may decide that some receivables, particularly if you have a significant number of them, are really not going to be collected. So it's not unusual to write that down. On the other hand, the inventory, buildings, unpatented technology, and process research and development are seriously undervalued. So the net adjustment, the net amount that they are attributing to very specific assets is a 910,000. So what it means is that of that 1.1 million, I can attribute 910,000 of it to these very specific assets. The remaining 190,000 I can't attribute to any specific asset, so that's going to be designated as goodwill. And goodwill is essentially the expertise of the executives, the great product, the great process, whatever you want to call it, that Richmond has, that is, indeed is kind of an inducement, an incentive for Miller to purchase the company. All right. Now, consolidation is a legal fiction, okay? And so what I'm going to be required to do is to create a worksheet. And the financial statements that Miller will issue that go to the public, that will be certified by the auditor, are based on these adjustments to a worksheet. That is, for example, here, let's find it here. This amount right here, okay, that's already been made. That was what I illustrated up before. At the time of acquisition, Miller debited its investment account. Now it's going to bring this forward, and we need to show that this is an economic unity. Legally, they're two separate companies, but an economic unity. All right. Now, with consolidation, and particularly with the worksheet method, the two basic things you need to do. Number one is to eliminate the investment account. This is all going to be gone. Why? Because a company cannot invest in itself. That what the worksheet reflects is this sort of economic reality that Richmond and Miller are now one unified company. So a company can't go and say, well, we're going to put $1.7 million into factory A or department A and treat that as an asset, okay? That would, you can't create an asset in that manner. So that investment account is going to have to be eliminated. Later on, we'll also look at any kind of intercompany transactions. Now, the other part of this is that because we have this economic reality, like we did with the statutory mergers, we want to bring the assets in, the assets of Richmond in at their fair market value. So we'll have to make a couple of adjustments here. Now, one of the things I like about this book, these authors, is that they take this consolidation process step by step by step. This chapter is solely looking at what happens, how do we do this consolidation only at the time of consolidation, and only if we're looking at 100% purchase, okay? So we're not going to make it complicated. This is the basics, this is the fundamental of consolidation, and subsequent chapters are going to build on this basis. So be clear, be sure that you understand what is going on here, because everything else we're going to do is going to be built on this basic model. Now, the consolidation is really a series of adjusting entries that take place. As I said, the first thing we need to do is to eliminate the investment. And so the first thing we're going to do is look at what's called, and the book will be consistent with this, what's called the S eliminations. And the S elimination is to credit the investment account and get rid of Richmond's equity accounts. Because in a sense, okay, because Miller owns it, Richmond's equity is irrelevant. So we get rid of Miller's equity. It doesn't really have any place in this. Because really, we're reporting for Miller, okay, and the assets that it controls, but not as equity. Because in a sense, the investment account reflects, if you will, the equity in Richmond. So that's going to be the first step. So you make the credit entry, if you will, here to, again, this layer, kind of peel off layers off the investment account, make the credit entry 600,000, and then make these entries down here, which get rid of the equity account. All right. Well, the next step in the process is to do what we did above with the statutory merger. We go through and we add in the fair market value of the assets, okay? And in this case, what we want to do is that say, okay, fine, that Richmond has the $300,000 receivables, but we felt that they were only worth $290,000. So we'll make this little adjusting entry here, credit entry. So if I look at the two things here, the debit of $300,000, the credit of $100,000, that has that net of $290,000. Okay. Inventory. Okay. In this particular case, inventory is seriously undervalued by $210,000. So the $600,000 is sitting there as a debit, plus the $220,000 brings it up to its $820,000. I'll do the same thing for the building that we believe is worth $900,000. So we have to make this debit entry to bring up its value to the fair market value. Now, with the worksheet, I can, in a sense, create assets. Now, these assets only show up, I'm not going to go back and create these in the books of Miller. These are only worksheet assets. So what I do is I debit goodwill for the amount that I've already calculated. They paid the $101.7 million, and they paid what, $190,000 of that can be attributable to goodwill, as we showed earlier. The unpatented technology is something that we're willing to pay for, as well as research and development. Again, these three entries here only show up on the worksheet. Miller will not go back and debit goodwill. They will not go back and debit unpatented technology. They will not go back and debit research and development cost. They only show up on here. So that takes care of it. Those are the sum of all the things I need to do for this consolidation process. You bring these over, and so these are what will be reported to outsiders. These are what are subject to the audit. So not only for those working within a company, for auditors coming in, they're going to start from these numbers and work backwards to determine whether those numbers are in fact fairly stated. Okay, we'll talk a little bit about this, but I don't want to make a huge issue out of this, what we call sort of a bargain purchase. It happens for a number of reasons, and it's not unusual for companies to try to snap up companies at a bargain for a lot of different reasons, and we're not really need to get into that. But if we look at the consideration that was offered, and in fact we assume that was accepted, they're giving up stock which has a fair market value of $1.3 million, plus a contingency of $100,000. So that gives you a total of $1.4 million. Now, as we discussed above, the fair market value is the $1.51 million. So they're actually buying it at less than fair market value, which results in this $110,000 gain. Now, this gain is recognized immediately at the time of acquisition. It flows through Miller's income statement to its retained earnings. And so if I look at the difference between the consolidation that I did in Part A up here, that as they say here, net income would be $110,000 greater than it is under the where they pay more than fair market value. Because they're paying less than fair market value, it's pretty obvious that there is no goodwill. Okay? Now, the other element here, if I'm looking at a difference, and what the answer here is focusing is on the difference between what you see in Part A for the consolidation, where they give $101.7 million versus the 1.4. Well, it's pretty clear that if I go back to the difference here, that is one option, they sell the stock at a fair market value of $32 per share versus $26. Well, that's $6 per share that has gone down. And if I take 6 times 50,000, that equals the 300,000 of paid in excess. It's not going to be there under this bargain purchase agreement. So yeah, the paid into capital will be $300,000 less. Likewise, retained earnings would be $110,000 more, as I discussed earlier, because the gain is recognized at the time of acquisition. All right, and finally, kind of a quirky element here, that when there is a bargain purchase like this, okay, the investment account of Miller is going to be debited to $1.51 million, and that is the fair market value of the assets. Even though they paid the 1.4, you have to bring the assets in at their fair market value. So in this case, yeah, it is kind of a goofy exception, but it's one that you're going to have to remember.